Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
It is now my distinct pleasure to welcome back David Hunter to the Contrarian Investor Podcast. David, thank you so much for rejoining us today.
Yeah, hi, Nathaniel. It's been a long time. Great to see you.
It has been a little bit of a long time, and so I'm very curious about your views, predictions on the market, on the economy, and on everything else. I was initially hoping to get your views just on treasuries because those have sold off. So maybe we can start there.
Sure.
Because, we did see a big sell-off in treasuries. What's your view on the bond market right now?
Yeah, I'm a bull on the bond market. I think what we saw the last couple of months was obviously back up after some reports that suggested inflation might be rising again. The Fed, doing the higher for longer mantra. But I think the biggest thing was the big issuance that we had from the Treasury, and we had to absorb all that. At the same time, both China and Japan were selling treasuries for different reasons. So I think the market got very nervous about who's going to absorb all this supply, and clearly rates backed up to be able to do those auctions. I think that's mostly behind us now. You're going to have obviously auctions all the time, but in terms of the volume, I think we got through that big amount, and it looks to me, I still believe we're heading towards inflation continues to slow. We're heading towards a recession, and ultimately, I still believe we're heading for a deflationary bust. May get stretched out, but it's next year in my opinion, and yes, the Fed's still holding rates high, and they're still talking about higher for longer. But I think what you've seen in the recent, comments coming from various governors is the consensus is developing around, hey, maybe we're done, or certainly we're due for, we're going to pause for a while and see what happens. I think they're seeing the strains that are showing up in the banking system, particularly the regional banking system. I think they're seeing, although the economy is showing amazing resilience, I think they're seeing that there's a very bifurcated economy with the haves of the bigger income groups showing that they have plenty of savings and they're still spending, but at the low end there are some disturbing signs about delinquency rates on credit cards and auto loans. And obviously we know student loans are just beginning to come back into the picture. So all in all, I think the Fed is saying, we've done a lot of our job. Inflation has trended down and looks like it's going to continue. Maybe we need to be careful not to break everything.
What do you think is the biggest input for the Fed policy at this stage? Is it still the inflation data? And do you think there's not any risk there that it continues to print hot and forces the Fed to raise further?
Yeah, I mean, it's always a risk. And certainly in short term, you get month-to-month numbers and you never know. We're playing games when we worry about a 0.1%, a number that comes in 0.1 hot, and we get upset by that. Frankly, I think the Fed, they give lip service to leads and lags. I don't think they really understand the lagged effect, and that their history is that they always stay the tightness too long. And I think this time It's even more dangerous that they're doing that because the leverage in the system is so much higher than ever before. And I want to stress that we had plenty of leverage in 2008-9, and that's why we paid a price. Certainly plenty of leverage in our banks. But the overall system today, it has leverage so much higher than we even had last cycle, last down cycle. So if the Fed makes a mistake here by staying too tight for too long and underestimating the lagged effect, we're going to see a much bigger downslide, I think, than we even saw in 2008-9. And that's why I'm talking about a global bust.
Yeah, yeah.
And again, it's not just the Fed, it's central banks around the world. They're all kind of mimicking each other, and they're all staying pretty tight at a time when Europe doesn't look like it's in good shape. Certainly China is struggling. And Japan's in its own little world right now. But monetary economics have not been, you haven't seen that go away in Japan. I think it's just taking longer to show up, but you're beginning to see where their interest rates are starting to break above their bands, meaning they're having a harder time containing them. And given the policy they've pursued for several years, once they break above, and if they break out anything like here, they've got a huge problem on their hands, because they've monetized everything. They own all the bond market.
Yeah. How soon do you expect the Fed to cut rates?
I'm not sure. I actually have I suggested, and I won't call it a theory, but I think there's a possibility that what we get here is a pause. And a pause, I've said this all year and probably before that, that's all you really need for the market. If you get a pause and the market takes that as Fed tightening is over, that takes that stiff headwind out of the way. It doesn't have to be a tailwind. You don't have to cut rates, but if you take that stiff headwind out of the way, there's enough other things that are going to push this thing, including all the bears out there that have to reposition. So I think pause is the most likely thing until we hit the bust. However, I think the risk here is that they pause, and if we get what I'm talking about, we can talk about this in a minute, but a melt up to 6,000 or 7,000 on the S&P, given the Fed's history a year ago, they bought into Bill Dudley's thesis that you got to get the market down to tighten conditions. They've kind of abandoned that this year because it hit them smack in the face. They kept trying to jumbling the market down. Instead, the market went up 30%. So, when they came into this year, as they moved into the year, they started kind of backing off on the jawboning. So I think the market is no longer, they may be watching it, but they're not trying to talk it down as much. However, if you get a melt up to 6,000 or 7,000, they will come right back in and say, "Hey, look where the market is. We've got to tighten." So even if the economy is not in great shape, as either in recession or very close, they could ignore that and focus on the stock market if we're up there. Because I think they're still very nervous that they don't want to be perceived as the Fed put. The whole criticism over the last couple decades is the Fed, recklessly propped up the markets when they shouldn't have. So even though they're not doing that now, I think that would make them nervous if they saw the market up there. So what that might mean is that we get a pause and then they come back in retightening, meaning starting to hike rates again. And they might be doing it on the eve of a disaster. On the eve of a bust, because they don't realize the leads and lags. So I think that's the possibility. Less likely possibility is obviously that things break pretty quickly here and that they do cut rates sooner rather than later. But everything you look at right now, the economy is still showing that it's not imminently close to nosediving. I think we're going to see kind of this slowing but steady as she goes type of an economy for at least a few more months.
So it sounds like you're saying the bigger risk is to further tightening and over tightening by the Fed, right?
Yeah, no, actually, I think the Fed's already, as I say, the seeds are already sown for a bust. So I think the Fed's already done its damage. It's just you won't know it for several more months. However, if they've done that damage and then they come back and do more damage, it makes it even worse. So, whether they tighten more or not, I think they've gone too far. And as you know, they're continuing to take money out of the system. And I saw comments recently that made me very concerned that I forget who it was. It might have been Kashkari, but somebody said that they think they can take money back to the levels of balance sheet, back to the levels it was pre-pandemic. If they do that, well, this thing is going to crash big time. So, I mean, that's longer term thinking. I think they're not talking about doing it quickly, but they are continuing to do QT. And at some point, that's going to bite. So both, rate hikes have done a lot of damage in the last year and a half, because you went from zero rates to 5% in a hurry, unprecedented. So that was the real tightening. But certainly in the last, many, many months, they continue to, shrink the balance sheet, and we're down $1 trillion from the peaks, and they show no signs that they're going to stop that. So I think that's the other concern.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
But you're still bullish on stocks here. You still think we're...
I am, I'm as bullish as there is on the street, I think, and probably more than almost anybody. I continue to think that what we saw in the last 2 months was a consolidation of the run from last October. So you had a 30% run in the S&P, 31%, and I think you had a 40% run in Nasdaq. It was, it was falling all the way up. The bears just kept calling a bear market rally and thought it was going to roll over until we got up above 4,300, and then the last couple 100-point run to 4,600. The investors kind of jumped on the bandwagon and got bullish and started talking about, hey, maybe we're going back to the highs. That was a sign that we had gotten back to the sentiment, back to the wrong side of the equation. And, consolidation, I pretty much called that we'd have a consolidation. I didn't know if it'd be 5 or 10%, and it turned out to be 9 on the S&P anyway. So what I saw in the last 2 months was just classic, need to consolidate, rebuild that wall of worry before we move higher. And I think we've completed the consolidation. We'll see. There's always a chance you can go a little lower, but I think we probably completed it. And that the next stop is, up around the highs, 4,800 area. And if we push through there with any oomph, we're off to the races in terms of melt up. So, the only question I really have is whether we pause at the highs for a little bit. I don't think it'll be a 2-month pause, but we might pause there a little bit, back off before we push forward, or whether we just kind of blow through there and keep going. So I think fourth quarter is shaping up to be a very strong quarter in the equity markets.
Mm-hmm. And to your point, we haven't even had a correction. This drawdown the last couple of months, 9%. Was it maybe a correction for the Nasdaq? I don't even know.
I guess that's semantics. I view it as a correction. I use correction, pullback, consolidation, all are the same. Some people want to define, bear market is over 20%, correction is under 20, whatever. We had a correction, and it's what you typically see in a bull market. And we're in the new bull leg as of last October, which I said at the time that we were starting a new bull leg. Like I said, we were up 30% on the S&P. And so what you have is a stair-step process. You have to constantly rebuild that wall of worry. If the market gets, if investors get too bullish and get ahead of it, it's going to burn itself out. So what I saw was a 2-month very healthy consolidation. Obviously, those that were bearish all the way up and then got bullish the last couple 100 points, they were bullish without conviction, is what I call it, because it didn't take them much. This 5% sell off, and they were all back on the bear side again, and 9% sell off, and they're talking about a crash again. So So I think what you've got out there is a lot of, rightfully so, I guess people are looking at valuations and things, and they're having a hard time understanding even why this market is up here. But, again, I think people are overlooking how powerful it can be if consensus moves to understanding that the Fed is done, or at least looks like it's done. That takes away that tailwind. I mean, that headwind has been there really since the middle of 2021. In the summer of 2021, we began talking about the Fed maybe needing to tighten. It kind of spent the second half of 21 still pushing up, and then obviously 2022 was bear market and Fed tightening. But so that headwind or concerns about when the Fed would start going the other way started in 2021, and it's been with us ever since. You take that away, and what you get is investors starting to say, I'm looking over the trough. I can start looking for, the next cycle's earnings and discount out a little ways. That can, and if everybody does that in a very short period of time, that's how you get a melt up. I mean, that's basically my thesis.
Mm-hmm. Yeah. You have also, though, employment still running quite hot. And unemployment claims haven't gone anywhere. We're pretty much at full employment. Is that not the type of thing you think that could move the Fed to keep tightening, or at least keep making, the comments that they're going to tighten?
Yeah, it's funny. Through my career, I've never been big on the jobs numbers as an important thing. I mean, it's obviously important to the economy, but I think there's the birth deaths adjustments. There's the questions between the household survey and the other. I just think those numbers are subject to a lot of error or a lot of misleading. They can be a misleading indicator. And this last report was no different. Most of that report, most of the strength that everybody reacted to, and you saw the reaction didn't last long. The reaction was because it looked strong. When you look below the numbers, you're getting a lot of part-time help coming in, probably because the lower end of the income scale is having trouble keeping up with the standard of living, or just basically affording necessities. So they have to get two jobs. And so, underneath the surface, I don't think the jobs picture is very strong at all. And what we've seen in past cycles is you can look good right up until you don't. And then all of a sudden things can deteriorate over just 2 or 3 months. So I have never been a big fan of using jobs as your most important indicator besides inflation. They're trying to balance those two, and I think that's leading to some of this error that they're making.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. Contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a Contrarian take on the events of the day ahead, and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Okay, so short-term bullish for stocks and for bonds. What are your targets?
Okay, for stocks, it's S&P 6 to 7,000. It's a broad range. Most of my other indexes, I have just one target, and as I said yesterday on Twitter, basically those are my minimum expectations. The S&P, because I tend to talk about the S&P more as a proxy for the market, I've got a lower and an upper target. So I actually think we're probably going to go above my minimum expectation. So all my other targets, Nasdaq 20,000, Dow Jones 48,000, the Russell 3,000. So I think those are minimum expectations and could go beyond that. If we get into this melt up / blow off, I think it's going to be obviously very driven by emotion at the end and be vertical. In a vertical market, when you get into what is I call a top of a 41-year secular bull, it can go wherever it wants in a very short term. It won't stay there very long. But if you get a lot of money chasing things, I think we're going to find, this can be a buying stampede where we're going to find that there's not as much stock liquidity as you might expect. That if everybody's been on one side of the boat for so long, mostly bearish and cautious, if they all in a very concentrated period of time move to the other side of the boat, I think you're going to see a lot of price movement as people try to get into the market. So, there's short covering, there's just people needing to reposition. Hedge funds, I think, are pretty short. So on the stock market, I'm obviously the bull on the street, I think.
Yeah. I mean, that's 50% upside from current levels.
Yeah, and I'm saying it can happen in 3 to 6 months.
Okay.
So it's not, people may say, oh, 6,000 is not so bad. I think we could get there in a couple of years. That's not a melt up. Melt up is something that happens in a much steeper fashion. So whether it's whether we get most of it before the end of the year or we see it into the first quarter, who knows? It seems crazy when you're here, but it seemed a lot crazier. And I was using those same numbers at when the S&P was 3,500. So, yeah. And on the bond side, I'm probably the bull on bonds as well. And it's not going to happen in one fell swoop, but I think we basically have topped out in rates. And I think you're going to see the 10-year get down to 2.5% during this melt up. So again, it probably not all in the fourth quarter. I'd say fourth quarter, first quarter type of move. And again, because everybody, we've probably got a more bearish positioning now than at any other time. I saw hedge funds are extremely short, historically short on bonds. So I think you've got a lot of repositioning there to go as it shows that inflation is actually going down. The other story in bonds, I think, is I have a view that, and I was getting beat up at when WTI was 95 because I had called the move down to the 60s, and then I said we could be in a trading range between mid 60s and mid 80s. Well, it blew past mid 80s and was 95, and everybody was assuming it's just a few days to 100 and then 120 and 150. And I continued saying, no, I don't think this has legs. Well, finally, rolled over. And I do think we're probably heading back into the 60s and maybe down to 60 in the bust, which is, still a ways off next year. But in the bust, when we have global bust being something worse than 2008-9, I think demand's going to fall like a rock globally. And you could get oil down to $30 or $35, somewhere down there. So I'm, but just looking at the near term, if oil goes into the 60s again, that's another tailwind for bonds. I mean, it will help the inflation story, obviously. And I think inflation has pretty much peaked out, even the short-term blip. and should roll over. So I think both short and long rates ultimately will come down, but for the 10 and 30 year, I think you're going to have interest rates coming down, the bond market going up during the melt up, and in the bust, you see the last part of it where I'm calling for a 0% or below 10 year in the bust.
Wow. Okay.
So there's, I would say, there's probably a few, but the vast majority of people think we've seen the lows on rates for this cycle, right? The 0.4 we had on the 10 year back in 2020, most people think we're not going back there. And the 30 year got down to what, 0.9 or whatever it was. I believe you could even see negative rates on the 10 year. We'll certainly, I think, see negative rates on short rates. And we could see the 30 year down to 1/4 or 0.5%. The reason I can get there is in a bust, I believe you're going to see all central banks, we'll focus on the Fed, but all central banks flooding the system with money like we've never seen before, because a bust means you're having a financial implosion. You're seeing the banks around the world dominoing across the world with failure. Less so in the US this time because we got hit so hard in 2008. They're better capitalized, but that doesn't mean we won't see them, 1 or 2 or 3 here, and certainly in the regional banks we'll see it. But over in Europe, over in in Canada and Australia, those banks are highly leveraged. Their systems are leveraged. So I think what you're going to have is a deer in the headlights moment where all the central banks are going to say, we don't have a choice. We got to turn on the spigot again. And they're going to, I predict, again, what do I know? But I predict that it's going to take an expansion of the Fed's balance sheet from what is 8 trillion now up to something like 30 trillion. So if you get another 20 plus trillion pumped into the market, we had 5 trillion, was unprecedented. And that was, we saw that in 2020. If this is 4 times that, 4 or 5 times that, imagine what that does, because that means you're monetizing the bonds, right?
Yeah.
You have to put money in the system, you have to buy bonds. The Fed will be monetizing a lot of new issuance because accompanying that monetary input will be a big expansion of fiscal. They'll be doing everything they can to, pull us out of a nosedive, and we'll see that all around the world. So, but you can get a zero when people say, well, I don't see how you could ever get rates to those lows again because you don't have China buying and Japan's not buying. Well, that's all going to be replaced by central bank buying and then some. And of course, as rates come down and the economy's heading south, you're going to see a lot of institutions buying bonds again. So there'll be plenty of demand that can get us there if I'm right on the bust.
Yeah. And the Fed is the biggest single purchaser of treasuries. So there is that, bigger than any anybody or domestic.
I should say though, because some people misunderstand it, I am not, this is not an endorsement of what's going to happen. I'm just saying that basically because of where we are in the super cycle and because of all the excesses, this is what I predict is going to be the response.
Mm-hmm. So you don't think the Fed has learned from their mistakes, basically, because they did this already. They've done this a couple of times, and they didn't have inflation until this last round, in the 2020, and that's what led to all this inflation. And now they've arguably overdone it on the tightening side. So you don't think they've learned from this, and they're going to be like, "Oh, we can't flood the market."
Yeah, they think they've learned. Let's put it this way: they certainly are currently saying we're not going back there. QE's done. We are not playing that game anymore. That's easy to say when you're in your gradual policy moment. When all of a sudden, stuff hits the fan, and you're staring, like I said, it'll be deer in headlights. You're staring at something far worse than the spring of 2020. They're not going to sit there and say, well, gee, if we do this, it's going to be inflationary down the road. They're going to say, what do we do to save the system? Because what's going to be hitting them right in the face is, what we saw in 2008 times 10. There's going to be banks failing quickly, like we saw in the fall of 2008. Like I said, more concentrated overseas this time, but the Fed's still the primary, provider of liquidity in the world, and we're going to be hit too. So it's not going to be easy here, but there, I think it becomes inevitable. That's the only tool they can use quickly, because if you say, okay, we're not going to use monetary tools this time, we're going to maintain our discipline on money, and we're going to let the government handle this. Think about how long it takes for the government. We'll all be in caves. I mean, this thing will happen in days and weeks. The government takes months to come to agreement on things. So they did very well, considering back in March of 2020. But I think also everybody's mindset now is we don't want to do that again. So their first response is going to be, we already tried that. We don't want to get into that trouble again. But then, a day after they say that, they're going to be seeing more problems, and ultimately they'll reach their conclusions. But so it's going to take a massive fiscal and monetary response to stop a free fall. Basically, you're looking at, if you don't react, you're looking at the implosion of the Western financial system, maybe the worldwide financial system. And as long as they have the wherewithal, they will try to stop that. And by the way, the other key component is, and again, I don't think there are very many people with this forecast, but I think we're going to be in deflation next year. Once the bust hits, not before the bust, but once the bust hits. If they have deflation, the last thing they're going to be worrying about is inflation. And and once you're in that deflation, it doesn't turn around quickly. The inflationary lagged effect to the monetary response is 18 months to 24 months. You're not going to be, they're not going to be thinking about inflation when you're looking at deflation. So that gives them almost infinite ability to print, because the problem of that printing is down the road. The thing that they're facing immediately is the deflation and the implosion. So,
and fiscally, you think that the government will be able to summon the wherewithal and the practicality to actually get things done after this happens again?
Yeah, I think so. Probably not immediately. They're probably going to battle. The Republicans are going to look at it and say it's fiscally idiotic, but they're not going to have a choice, I don't think. They're going to have to be bailing out all kinds of things. And so, again, this is not an endorsement. In the end, this will end very badly, but you're going to be kicking the can down the road for one more cycle. Ultimately, what this begets is an inflation cycle that will blow away the early 80s. I mean, I think you'll see 25% inflation by the end of the decade. You'll see, and you'll have, instead of having 300 plus trillion of debt today in the world, you'll probably have 450 to 500 trillion, with our debt in this country being if not double, certainly up 50%. How do we solve that equation? We can't. I mean, that's why I say I'm not endorsing this, because what's going to happen down the road is by sometime late this decade, we're going to be bankrupt. I mean, the interest costs of servicing that debt are going to be the entire budget. The Fed's not going to be able to print a penny, because inflation's roaring ahead, and every extra dollar you print is just going to create more of a forest fire. So ultimately this ends very badly. I think the 2030s is a collapse of the financial system, and who knows what comes out of it. But there'll be, I mean, I say this without having any ability to know whether it's not coming from any real analysis, but we could be looking at 50% plus unemployment in the 30s, with no unemployment, no welfare system to speak of, little or no Social Security or Medicare. I mean, because the government will be bankrupt, and certainly, a military that's basically, which is having trouble now, that will be unable to be financed. So, I mean, it's not a pretty picture. And again, it's because we've been doing this over and over and over again for 80 years. It started post-Depression, post-Great Depression. The excesses built up gradually, and then in the last 20 years, they've accelerated. And we just have put ourselves in a place where I think it's like the rubber band. It just keeps getting bigger, wider and wider. Every cycle, you have greater excesses, and the responses to those excesses create bigger problems. And I think we're at the end. We're nearing the end of what it will ultimately be a 90-year super cycle.
Yeah. Now, we did have some periods in there where it was driven by productivity, but we had low inflation and good growth. The 90s, basically.
Yep.
Maybe that wasn't engineered by the Fed. You could say the housing bubble was in the early 2000s, et cetera. So you don't think there's a chance that could happen? That basically we could actually get out of our own way and have some healthy economic growth for once?
Yeah, it'd be nice. I mean, with AI and things, there's talk that we might have a surprise boost in productivity that can really help the situation and keep inflation low, et cetera. I guess my response is that I think we're so far along in this that what's set in play already, meaning the seeds are already sown, first gets you what I call a bust, and then gets you the response to the bust. So the macro just blows away what would otherwise be benefits that could maybe stretch this thing out and get us out of it. But I just think we've put ourselves so far down the road that I don't think those offsets are anywhere near going to be able to take care of what we're facing.
And don't forget, we also do have a declining population, which would factor into that as well. I mean, at that point, doesn't everything, politically fall apart, like civil society? I mean, if you can't, like you're saying, if you can't service unemployment benefits, if you can't pay Medicare, if you can't pay Medicaid, that's what.
Yeah, I think,
if you can't pay the military.
Yeah, as I say, I think it's impossible to predict what comes out of that, but I would worry that totalitarianism comes out of that. There's obviously the fourth turning story out there, and some people want to say, we'll cleanse this thing and start all over, and it'll be a new capitalistic cycle. I hope that's the case. I mean, as I tell people, as it's not that far away. The 30s is the next decade, but there's so much between now and then to happen. If I'm right, a melt up here, then a global bust, and what could be an 80% decline in the stock market. What I call historic bear market, and then out of that, a huge inflation cycle that will drive commodities through the roof, so that you can make. There's another cycle to make money. So to look over all those historic things and huge moves to something that's an unknown, I don't want people losing sleep over something that we'll get more clarity as we go along. This is just my sense doing. I've done long-term macro stuff for years, looking at all the things that go into the equation. I just don't know how we solve it without something quite dire in the 2030s, and then beyond that is just, it's too foggy to know. I know what I fear, but I can't say that's what will come out of it.
Yeah. And the 1930s certainly sets a bad precedent for this in terms of fiscal problems and economic problems that led to totalitarian governments in various parts of the world. But on a brighter note, it sounds like there are still opportunities here, a couple more cycles, in fact, for people to make money. Like we have, stocks and bonds now until, when do you see this concluding? You think like some point mid 2024?
Yeah, I think, I use kind of 3 to 9 months, depending on the asset. Like I think the metals are just coming alive after a long period. I mean, they had a great run in the first decade of this century. Then they had ups and downs for the next, 13 years or 12 years, I guess. And they had some periods where they rallied, but I think you're about to have what we saw in 2016 and again briefly in 2020 after the coming out of the
COVID,
market
yeah.
boom, you had two big runs in the metals. I think you're on the verge of another big one here, and where the metals themselves, I'm calling for 3,000 gold within the next 6 to 9 months, and probably 6 months is very possible. And silver could go to 60, and I've said if I won't be surprised if it goes 75 from we're at 22. So those are huge runs, and then the miners will be multiples of that if it happens. You go back and look at 2016, and you had a similar thing. 2020 was shorter, but pretty big move. So that's why I think we're set up for near term in the metals. They'll get hit in the bust like almost every asset, but coming out of the bust, commodities, including precious metals, will be the place to be. I mean, we've had this long cycle coming out of 2009 that was really technology. If you look at where they started in 2009, where they are today, they've had tremendous cycle. The next cycle is going to be high inflation, high interest rates, commodities, and growth stocks don't thrive in that. That doesn't mean there won't be technology stocks that do well, but in general, I think the next cycle after the bust is a commodity industrial cycle. So kind of more back to the 70s, except bigger. And, I think oil can go to $500. Like I said, it can go to 30, 35 in the bust. From there, go to $500. Silver.
What'll that do to gas prices?
Yeah, you're talking $20 a gallon easily, That's why it's going to be it can't go on very long, right? Typically commodity cycles are short. Disinflation cycles driven by services and consumer can be long, like the last couple of cycles have been. Commodity cycles burn themselves out because you can't sustain those prices. It's going to be a supply demand story where we've policies have really hurt us on the demand on the supply side for quite some time here, and particularly under the Biden administration on energy. Going away from fossil fuels towards these alternatives and trying to do it in such a short period of time is just nonsense, and it's going to lead to the opposite. You're going to have fossil fuels are going to be in big demand, and you're not going to have the supply to meet them, because it's going to be an industrial recovery cycle, because of reshoring, et cetera. But you've got a great opportunity if gold goes to 20,000 by the end of the decade, and silver goes to 400 or 500, and oil goes to 500. I mean, you've got opportunities there. You're just not the same opportunities you had this cycle. Every cycle has new leadership, so people have to understand. Don't go with what got you here. Understand that the next cycle is going to take new thinking, and to carry that a little further. Really, since the disinflation cycle started in basically the early 80s, 83, let's say 83, 84, index funds have outperformed generally most active managers, right? If you were just this process didn't really start till later in the 80s, but if, let's say, we had the foresight for all these plan sponsors to say, your options are going to be S&P index and Russell index and what have you. If you had just put your money in there in 1983 or 4 and didn't try to fool around with the market, you made big money, and you outperform all these guys that get paid big money to be money managers. The next cycle is going to be very different. The next cycle, because the biggest thing that indexes have going for them is that interest rates went from 15% down to almost zero. PE multiples went from single digits up to the mid-20s. So the next cycle, you're going to have the opposite. You're going to have interest rates going through the roof. You could see 20% interest rates, maybe higher. And what's that going to do to PE multiples? It's going to shrink them. So, growth stocks and index funds and things like that are going to have that huge obstacle in their way, or that ball and chain on them, whereas the commodities have the pricing power to produce earnings that will outstrip inflation. That's the secret.
Yeah. But also, it sounds like you're saying active management could make a comeback, and that,
Absolutely.
yeah, stock
Yeah.
pickers.
Yep, it's going to be the haves and the have-nots. Those that are smart enough to understand that the new cycle is new leadership, and that leadership is inflation hedge and commodity driven. You'll have plenty of industrials that'll do well. Steel, a lot of machine tool and things will do well because I think it's going to be reindustrialization. Semiconductors in the tech area may do well because it is the commodity of tech. But in general, yeah, it's active management that understands and selects the right sectors and the right stocks will far outperform indexes.
Mm-hmm. But you think the commodities can do well? I mean, you need demand also.
Well, the demand is going to come from, well, first of all, you're going to have that massive printing of money that doesn't lead demand and all at once, but it will flow into the system. And as we've seen, last couple of years is a good example. It builds momentum as it goes. And so there'll be a lot of money sloshing around the system that will build demand. The demand will be targeted towards, I think, we're building new plant and equipment in this country, bringing it back from China. I think that's going to accelerate, because we do have geopolitics that overlays all of this. And I think the world's not going to get easier. It's going to get, there's going to be more tension, not less.
Yeah.
So there's going to be more bringing, I think companies are going to start realizing, as they have begun already, that it's not simply you can't just look at the cost of labor or the cost of building a plant in another country. You have to look at the supply chain issues. You have to look at the geopolitics of it and whether those things can get, your supplies can get cut off because of that. So I think there's going to be a recognition that we made a big mistake in kind of, this whole comparative economics of shipping all your capacity overseas and thinking the world's one happy place. I think that's gone out the window now. And so I think there's going to be a huge boom in industrial, and industrial requires
raw materials,
a lot of raw materials, and including fossil fuels. So, and again, kind of like the stock market, when that all happens in a concentrated period of time, price goes through the roof.
Yeah. And, the one thing that you can get Democrats and Republicans to agree on right now is a need to decouple from China.
Right.
There may be, that's the one thing that, so you would think there would be some momentum for that. There already is, obviously.
Yeah. And keep in mind, this is a global phenomenon. It's funny how these things, we focus on our own country, but, the inflation traveled around the world. It wasn't just here. The supply chain thing traveled around the world. It wasn't just here. So you're seeing it elsewhere. Germany's certainly going to, look at that. The UK is looking at that. I mean, China's got its, expansion plans, which are industrial, and you're going to see a lot of need for raw materials. So it's a global thing. We can see it very clearly here, but I think it's going to be a global story.
All right. Well, there you go. David Hunter, thank you so much for rejoining the Contrarian Investor podcast and providing us with these updates. Always great to have you. In conclusion, maybe if you could tell our listeners how they can find out more about you. I want to preface this by saying that my podcast and my newsletter is different than David's. I have people subscribing to mine thinking they get you, and they get me, and they get all upset. Well, that's actually disclosed everywhere that we have no affiliation other than having you on as a guest.
Right. Yeah. We have the same name in our,
but that's it. I have dozens of people on as guests. Doesn't mean anything.
I get every once in a while, I get an email from Nathaniel or a forwarded email saying, this person really is intended for you.
Right. Yeah.
So people need to be aware of that.
So how do they find out more about you? Yeah.
Sure. I'm on Twitter most every day. And my handle is at Dave H. Contrarian. So not David, but Dave H. Contrarian. As I always say to people, there are a lot of fake accounts out there. I hate that Twitter doesn't take them down, but people that have a decent following, and I've got a pretty good following, we all deal with these fake accounts. They take your profile page and put it up and they change one little thing in the handle. So instead of at Dave H Contrarian, it might be at Dave H Contrarian with an M or some other thing. So I just caution people, because I'm amazed at it, but I have a lot of people who are following what looks like me because it's got my profile picture and it's just, the handle looks similar. But the way to differentiate is I've got 193,000 plus followers. Most of these fake accounts don't have 1,000 followers. So I only have one account. So don't assume it's me, but with another account or something. I only have one account. And then also, if I might just let people, because I don't advertise it on Twitter, I do have a quarterly letter, and I charge a fee for it. So if people are interested in it, like I said, I don't talk about it on Twitter. I don't put out information on Twitter. But if they want to direct message me through Twitter, I'll be glad to provide them details about that. It's a quarterly letter, so it only comes out, every 3 months.
And that's the only way to get that access to that quarterly letter is to direct message you.
Yeah, direct message me.
There's no other way. Do you have any other social accounts?
No, I mean, they can email me, but it's easier just to direct message me. Yeah, I don't have a website. I don't have any other accounts, so I'm not on any other social media. I don't have YouTube, etc.
Okay, all right, yeah. So again, don't contact me if you want to subscribe to David. Contact him directly. And that's all we got for today. Thank you all for listening, and thanks again to David for coming on. With that, we'll shut up. See you back here again next week. Speak then. Bye.
Thanks, Nathaniel.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.